Welcome. So in this video, I'm going to talk about what does a buy, borrow, die portfolio actually look like. Now, this strategy is 100% not for everyone, but I'm going to talk about it anyway because this is how family offices structure portfolios, how billionaires operate, and how some of the strongest investors operate. So any stocks I'm talking about in this video, I'm not telling you what to invest in, I'm not telling you what to do. This is just my own opinion, and I'm giving you the reasons why, and I'll give you the math to back it up. So here we have Chris Hohn. This is a very concentrated investor, high conviction investor. And as you can see, he's very concentrated in his investments. And he only invests in companies with absolute pricing power. And I adopt this strategy myself. If the company doesn't have pricing power, I don't invest in it. And that's just the way I look at it. So what are we going to talk about? I'm going to talk about a dummy portfolio that I'm going to make up and how I would look at the buy, borrow, die strategy on it. Now, if a normal legacy financial advisor looked at this portfolio, or the typical person looked at the portfolio, they would literally fall out of their chair because they look at it as highly volatile and dangerous and gambling. And they would say the same about Chris Hohn's portfolio, to be honest. You know, it's a concentrated portfolio, and he would get criticism off of a standard financial advisor. And let's give another example of who has a concentrated, dangerous portfolio. The Gates Foundation. Gates Foundation here, look, 80% concentration across 5 companies. Yeah, if you showed that to the typical person, they would say that is risky, that is dangerous. What if the companies go bankrupt? And I just laugh off these comments because when you really look at it, it's more likely the people making these comments, it's more likely everyone they know would go out of business and they would all lose their jobs before any of these companies actually would face bankruptcy. But anyway, let's look at the portfolio that I've just drafted. What if we went 70% Nasdaq and 30% defensive stock companies? So we're getting the growth, but we're also got protection. And you'll be amazed at how much defensive stocks protect this portfolio. So let me give you some examples of a defensive stock. Right, so the most defensive stock of all, right, Walmart. Let's look at Walmart. Walmart was the only company, as far as I know, in 2008 that actually went up. So someone that just held the S&P 500, let's imagine in 2008, their 401k or their portfolio was just the S&P 500. They were diversified. So their financial planner says, look, you're safe because you hold 500 companies. And someone that just held, 30%, 20% of their portfolio in Walmart would have been more protected from the crash. So Walmart's an example of a defensive company. Costco's another example. Visa, MasterCard, Moody's, S&P Global. I would class these as defensive companies. Berkshire Hathaway's practically got its own ecosystem. Very strong moat, like 380 billion of cash, owns railways. To me, that's a defensive company. Not all companies though. I don't believe all companies are defensive just because people say they're defensive. Once upon a time, UnitedHealthcare was classed as an absolute defensive company. So was FICO. But you know the problem is with FICO? The problem they had was their moat was given to them by the government. So therefore the government can take it away. Yeah, so the typical legacy advisor would say, yeah, this is a defensive stock. And they would say something like, well, that's a defensive stock, but ASML, let's look at ASML. ASML is a risky company. You know, that's a tech stock, so that could crash. But with that being said, the actual moat that the company has is it cannot be replaced. Someone else can't just make these machines. The entire semiconductor industry depends on ASML. But yet, we would look at that. Someone would look at that and say that's not a defensive stock because it's volatility, which is fair enough. But anyway, make a decision on the company if you believe that it's got a true defensive moat and it's actually a solid defensive company. Waste management's another one. You know, the government can't just take away the moat of waste management because they need to do something with trash. They can't just make trash disappear. So we have our defensive companies, 30% of the portfolio, say it's split across like Berkshire, Waste Management, Visa, or whatever one you want. $2 million portfolio. We are borrowing a loan of 400 grand. And I've calculated Nasdaq grows at 15% and the defensive companies say 8%, which I think is fair. So our total gross profit annually, the portfolio is growing by about 258k. Cost of the loan, I've put the actual cost of the loan at 4.64%. That's the current rate on margin. So after the interest is covered, it's still a net growth of nearly 240k. After we account for the money supply growth, it would be about nearly 5%. So we're getting strong growth on that. Now, of course, people are going to say, well, this is dangerous. You're borrowing against this portfolio. What if the market crashes? What if we get a dot-com bubble crash? I don't see a dot-com style crash happening again because the companies today do actually have earnings. But I'll humour you and say, fine, what happens if the whole market just crashes? And what's going to happen? Do we get completely wiped out? Now, I was racking my brains on this math all morning and I was shocked that how much the defensive stocks protect the portfolio, even just having 3 or 4 solid defense companies, how much they act as a ballast. So even if the portfolio crashed, you know, the Nasdaq crashed 35%, even the defensive stocks crashed 10%, the portfolio is still absolutely safe. Okay, so what happens here? Well, we've got an equity buffer still of $903,000, so we're safe. Okay, so here we go. What happens now? What happens now if the Nasdaq crashes 85% and the defensive stocks crash 24%? Surely that's it. The apocalypse. We're margin called. We're game over. No. We survive. We still survive. And I couldn't believe this, right? I was like, there's no way this is right. There's no way this can be right. I was sitting double checking. I'm like, how is this possible? But it is, because we've got 40% equity. So the total portfolio is 664 gross. And the defensive stocks, 454k. The Nasdaqs went all the way from 1.4 million to 210k. The loan is still 400k in this example. And we still survived. It's unbelievable. That's because of the defensive stocks. It makes such a difference, you know. Warren Buffett's protected the portfolio, or Waste Management, or whoever you decide to choose. So your net equity still, I mean, look, you're sweating. You're absolutely been sweating this whole time. I mean, most people probably bailed out and sold some stock at this point. But if you were absolutely rock solid conviction, you survived. I mean, this is also assuming you didn't deposit any cash the entire time. I mean, it doesn't crash 85% in an instant. It probably happens over the course of a few weeks. So we can still deposit cash if you really wanted peace of mind. But if you just had rock solid conviction and confidence, it survived. It's unbelievable. Now, what happens to the portfolio after 10 years? Compound growth is at 12%. It's worth 6.7 million. Look here, the debt in this case was unchanged, so it grows at 4.64%. Now I've assumed that's me also assuming the Federal Reserve do not hike rates. Sorry, cut rates. Do you think the Federal Reserve are never going to cut rates again when we have a sovereign debt crisis? The trick here is when they cut rates, this strategy just gets amplified like double steroids. The portfolio will grow more because rates are low and the debt gets cheaper. So we shrink the debt faster. Now, the portfolio after 10 years, the loan to value, they were only borrowing 9.3%. 9.3%. So we could borrow more. So you could take out 672k, withdraw for lifestyle. You can see why family offices are using this strategy. Why the strategy is effective. It's only effective for the real reason is that there's a sovereign debt crisis. We are taking advantage of the sovereign debt crisis. You can either be a victim of it, where you don't invest because you hate volatility. Fine. Don't invest. Buy some treasury bills. Hold some cash. Do nothing. And feel comfortable. Zero volatility. You can hold on to your cash and feel safe. That's how the people in Germany felt before their savings were vaporized when hyperinflated. It's sad, right? It is sad because most people are not educated on this topic and they just become victims. They don't realize their inflation itself is a tax and people are on the wrong side of it, getting vaporized. Whereas we are not. We are using the strategy because we understand it's a sovereign debt crisis. It's not going away. It's not going to magically go away. Yeah? It's not going to magically go away. There's 40 trillion of debt. If you hold productive assets, we benefit from it. We massively benefit from it. And guess what? This strategy, there's no capital gains tax to be paid. So imagine you have that portfolio there. You've got portfolio 6.7 million. And you let it grow for another 10 years. And another 10 years. And then we give it to our kids. And they give it to their grandkids. And our grandkids are chilling on a yacht in Monaco. Thankful that we used the strategy. But I'm just shocked at the fact that this portfolio survived. There's such a brutal crash. When you start to see the spreadsheet, you're less fearful of a margin call. Now, when would I actually pay money off the margin? There is one situation, and I've thought about this extensively. The only time I would actually pay down is when the Fed hike rates. That is it. Because they've reversed the game. They've reversed the rules. The rules have went inverted. Look at the money supply. The only time in history it went down by $1 trillion instead of up. It usually goes up. It went down because the Fed hiked rates. Liquidity seized up. Tech stocks crash. Your cost of your loan is going to go high. Okay, that's different. That's where I say, right, from our assets outside of the portfolio, we'll begin to pay some cash. It's not going to be, it doesn't destroy the strategy. It's more of a nuisance than anything. The last time the Fed hiked rates was for 14 months before they started gradually cutting them down. So yes, the stock market crashed in 2022. Because why would you need to invest in a stock if you can get a risk-free treasury bill for 5.5%? They gave the dollar strength again. Okay, they changed the rules. The rules have changed. We change with the game. As the game changes, we change. But good news for the strategy is there's $40 trillion of debt that's not going to get paid off. Therefore, we're going to slowly print dollars. And if you're not in the winning team, This strategy, for me, in my opinion, is the winning strategy. Fine, look, see if you don't want to borrow against the stock, that's fine. Honestly, at least you're investing. At least you're investing. If you want to do the strategy, you've got to get the returns, which at least is like the Nasdaq or single stocks. If you're brave enough and you get high conviction, you can invest in companies. When you invest in companies, I'm investing in, I ask myself, can they raise prices without losing a single customer? That cancels out, that removes like 80% of companies. It really does. But it's a good filter. I like it. That's my strategy. Everyone has their own strategy. When it comes to investing, you're going to have millions of opinions given different perspectives. No one ever agrees on the same strategy. But at least they're investing. So I personally don't like to over diversify. I just think you're diluting it. You may as well just call yourself a saver. You can't call yourself an investor if you are got an all-world fund, because you just want that emotional safety. But this is the thing what people don't realise, that volatility is not risk. People will say it's risky to invest in, say, Google. It's risky. But their own job isn't risky. The company they work for is more likely to go bankrupt than Google is, but yet people don't think of that. They don't think about that. They would rather, I mean, even if you set up your own company, that's more volatile and that's more actually risky than investing in a company that has a global monopoly. You know? And look at the returns of Google over the last year. It's unbelievable. 143%. The elephants can't gallop, is what they say. If the company's already big, it can't get any bigger. That's a lie. That's where all the liquidity goes first. Anyway, this is going off topic. The point is, buy, borrow, die. That is what a portfolio example looks like. Heavy growth and some strong defensive stocks to protect you from any potential margin calls. And most importantly, I'm borrowing 20% of the gross portfolio value.